Friday, May 3rd, 2024, Monaco 64, home of alternative economics and contrarian views. So we've got Clive as usual now on Fridays. Clive, how are you doing? Except for your head.
Yeah, good morning, Mario. And for your users, I didn't get into a fight with the wife. It was me having a fight with the garage door.
Yeah.
So I chose to headbutt it for some reason. And,
Okay,
but
great.
yeah, so I also survive.
Yeah. So this morning, we're going to look at a few things. Clive wants to look at the Japanese yen carry trade, which I've covered many times, but he thinks it's really important right now to talk about it. And then we're going to look at something that I've noticed, and that's how even the most supposed experts who have worked for the Fed still don't understand where the inflation comes from. And with that, we're going to look at some really interesting numbers going back to the 60s to do with the Federal Reserve's gold cover ratio, which used to be 40%. And then by 1968, Lyndon Johnson scrapped that and it was around 25%. So we're going to look at, do a little bit of calculation and see where gold would have to be now to cover all the Federal Reserve notes and also maybe to cover all the Fed's assets, which is would be an even bigger number. So Clive, nice to be with you again on Friday. So what can you tell us about what's going on in vis-a-vis the Japanese yen?
Well, first of all, it's been a pretty wild month for the Japanese yen. It's risen from 150 all the way up to, on Monday, it was over 160 against the dollar. And it's plunged back down in the last day or so to 153 to the dollar. A little bit earlier today, it was at 152.80 to the dollar. So that's been a wild week in terms of movements. But what I want to talk about is the carry trade and explain what it is and how it might go wrong. You probably, some of your listeners will have read about the carry trade in the newspapers, but they may not know what it is. What that is basically a hedge fund, and it's not for you and I to do, but the hedge funds, the wealthy funds which have a lot of money to play with, will borrow Japanese yen effectively at a rate of 0% or very, very close to 0%. They will then sell those yen and buy dollars, and then they'll put those dollars on deposit at 5%. So they're provided the yen does not rise in value, in other words, provided it doesn't go from 160 to 153, that's a rise in the value of the yen or a fall in the value of the dollar. Provided the yen doesn't rise in price, provided it stays stable or falls in value, they will make money because they'll make the 5%, the difference between 5 and 5.4 in the Fed funds rate that they're making, and the 0% nearly that they're borrowing at. And if the yen falls, as was happening for most of the last year or two, they're also making a profit on the fall in the yen, because don't forget they borrowed yen and they're going to pay it back with more expensive dollars. But last week, we saw this crazy ride for the yen as it rose in value from 159, 160 odd down to 153 today, which means those who put on the carry trade fairly recently will be hurting. Now, it's not that a hedge fund is borrowing once and making 5% for its investors. Hedge fund investors aren't really interested in 5% returns. They want much higher returns. So what hedge funds do to exaggerate those returns is they borrow many times their capital. They might be borrowing 50 or 100 times their capital to do the carry trade. And if they go too far out and get it wrong, then the margin, especially when we have a large movement as we've had this week, the margin calls can come in and some of them might find themselves at the wrong end. Now, most hedge funds have got very good risk management systems, so the minute things start to go wrong, they'll start to unwind the carry trade. But you never know. There's always things go wrong when you least expect it. And yeah, if I don't know of anything going wrong at the moment, but I just say the carry trade is one to keep an eye on.
Yeah, don't you
And
also think that, sorry to interrupt you, but it's not just hedge funds that use the carry trade, but I remember when the Swiss franc uh, euro peg broke, a lot of Eastern European uh, mortgage holders got creamed because they were borrowing Swiss francs, thinking that, borrowing at zero or negative, you know,
yeah,
Swiss franc mortgages, but then when the Swiss franc went up in value when the peg broke, they got hurt. So I think it's more than just hedge funds. You
yeah.
could see pension funds doing it. You could see, mutual funds doing it, and you could even see, yeah, normal investors, high net worth individuals do it.
I mean, just to explain how far things can move, when the Swiss franc peg broke against the euro, it went from 120 to something like 87 in a microsecond. And, that's just like a 30% move, 30 plus percent move. And a lot of people, individuals as well, who were at the wrong end of it, got really badly hurt. So you're right. And when we had at that time, there were a lot of Polish mortgage holders who borrowed in Swiss francs. It was a big selling point in Poland at the time. So yeah, they got hurt. Whether they ever got any compensation for being missold the mortgages, I don't know. But and there could be people out there who borrowed yen recently and suddenly seen the yen rise sharply. Well, it's not a big deal so far. It's only a 7%, not even 7%, about 5% rise in the yen. But that's a lot of movement in a week.
Yeah, and there's a lot of speculation now about the Bank of Japan intervening and driving the yen higher or the dollar lower. But I think the only solution for the weakness in the yen is that they raise rates more. They raise the base rate from minus 0.1 to zero, uh, and their CPI is around 4%. I think it should be more like 1 and 2, the base rate. But if they do that as well, you could see the dollar drop to like 120 very quickly, and it would be really disruptive. So, well, first of all, I think the guys at the BOJ are not very savvy about markets. The new governor there, Ueda, I think is his name. He's an academic, so they don't understand things. So yeah, I agree with you. It's like a dark cloud over the whole world's financial system, this yen situation, and it doesn't look like it's going to be resolved properly.
Yeah. So on Monday, the BOJ spent $60 billion to support the Japanese yen. Obviously, the yen had gone to 160. It was now falling too fast, and they panicked and they dived into the market. I presume they sold some of their treasuries to do that. I don't know how they got the money. They're 60 billion. Obviously, they got a lot of dollars in their reserves, but they dived in with 60 billion to buy yen, and that's why it rose so fast.
Yeah, yeah, but I've heard from people that the only way intervention works is if you intervene in the overall direction of that market. So, with the yen weakening in the last few months, it's going to be very hard for them to keep it down, to keep it, to reverse the yen weakness. And that's why I think the only solution is to raise rates to stop. They're doing QE as well, 40 billion dollar equivalent every month. I mean, that's crazy in my opinion. So yeah, talking about QE, maybe we could move over to the Fed. If you want to talk a little bit about what the Fed did this week, and then we'll go into what inflation really is and what Danielle DiMartino Booth, she worked for the Dallas Fed, and she tweeted that the Fed is trying to fight the sources of inflation. I don't think she realizes the Fed is the source of inflation. So I'll let you talk about what the Fed did, and then we'll look at some interesting numbers vis-a-vis Federal Reserve notes, the gold cover, and the gold price.
For a year or two, the Federal Reserve has been doing something called quantitative tightening. That's the opposite of quantitative easing, which we just talked about for the Bank of Japan. Quantitative tightening means that they try to shrink their balance sheet. And the way they do this is by allowing US treasuries to mature. And instead of reinvesting all of the money that matures, they reinvest some of the money. And I forget the figure that they'd said it was maybe 100 billion a month or something like that, that they were uh, not going to roll over. The rest of it, they roll over. What they announced at the most recent meeting, and I've forgotten the figure, I'm afraid, Mario, but they are substantially reducing the amount of quantitative tightening they're doing. That means that they're going to roll over more of their maturing treasuries, almost all of them to be exact. So they're moving slowly but surely in the direction of stabilizing their balance sheet as opposed to reducing the balance sheet. And the next step beyond that will be quantitative easing, which is when they step in to start buying treasuries, which the government will be issuing because the government needs to fund itself. And it may have to go to the Federal Reserve to buy those because the public at large may not have such a big appetite, given that they are not addressing the deficit problem. So when the Federal Reserve buys treasuries, that's quantitative easing, it gets the money by printing it. So whilst the government borrowing money is, in a way, an increase of the fiat supply, because when the government borrows money, it gets poorer and someone gets that money, and there's more fiat in the system. But when the Federal Reserve buys treasuries, it's basically turning longer term fiat, which is the bonds, into short-term fiat, which is much more inflationary because longer-term fiat is just a promise to pay you the fiat 5 years down the line or 10 years down the line. But if you get it today, it's very inflationary because the money is immediately in the system and it's available to billionaires, millionaires, and large corporations and others to go and buy things. And of course, that will push up the price of things like labor, push up the price of housing, it'll push up the price of things which are in demand, but relatively limited in supply.
Yeah, I think the amount they decreased the QT for Treasury was from 60 billion a month to 25 billion. So that's like 35 billion a month. And if you multiply that by 12, that's 420 billion extra reserves for the banking system. And the banks they lend out more than 10 times over. There's no reserve requirement. The Fed moved that to zero, I think, in 2020. So it means they've pumped just trillion. They're going to be pumping trillions of dollars into the banking system by just doing this, despite the fact that they came out and said, "Oh, we're going to keep rates, elevated for longer." But they're actually, I think, accommodating through this announcement. And yeah, and all these bonds that the Fed buys or doesn't sell, it results in the banks having more Fed reserves, and with those reserves, they can lend out more to the public, to businesses, to billionaires, like you said. So yeah, I want to bring up Clive, this tweet that I saw yesterday, and I
Mm-hmm.
replied to it. Let me share it with you and the viewers. And it's from, I think a lot of you have heard of Danielle DiMartino Booth. She worked for, she is like a writer, a reporter, but she worked for the Dallas Fed, and I think it was for Richard Fisher at the time. And she's an interesting analyst. She's written a book called Fed Up about the Fed, how it needs to be reformed. So I don't agree with that. I think the Fed needs to be abolished. But she tweeted this out yesterday. Always ask whether the Fed can influence the source of inflation. And she seems to be implying here that the Fed is fighting inflation and that it's auto insurance, food, gasoline, and healthcare that create inflation. So I replied, the source of inflation is the Fed because it creates reserves out of thin air. What you're talking about is the consequence of inflation or higher auto insurance, food, gasoline, and health care prices. And I also put here one of my favorite comments from the Raven of Zurich, Felix Sommery. And he said the state alone is responsible for inflation. Inflation without government or indeed against government is impossible. And I think by government here, he means, not just the Treasury, but the central bank. And we saw, Clive, I wanted to ask you this, that the Treasury is pushing for this buyback program. And I think the Treasury under Yellen is also pushing the Fed and Powell to do this unwinding of the QT or the tapering because they're worried. It seems to be some kind of de facto yield curve control. Maybe you could talk a little bit about this buyback and how it works.
So yield curve control is basically when the central bank tries to stop longer term rates from rising. And the way it does that is simply by buying bonds and pushing up the price, which pushes down the yield. I'm not aware that we're not in that yet, as far as I know, Mary. I don't know. Were you implying that they're doing that already? I
Well,
mean, they're doing it in Japan, but I didn't know a lot of the States.
yeah, I said de facto because what they're doing with the announcement that they're slowing down the QT, up until
Oh,
they
yes.
announced that, the 10-year was moving back up to above 470. Now we're below 460. And then you have the Treasury on the other hand they're issuing a lot more short-term paper. So it looks like the Fed is keeping the long end of the curve down by announcing this decrease in QT, and the Treasury is issuing a lot more T-bills to try to, take also not sell that much long-term paper. So I think that's how I see it. I mean, they haven't
There,
publicly.
there's another factor in play here. The US government has got no debt ceiling at the moment. It's been suspended, but it's only been suspended until the 1st of January this coming year, 1st of January 2025. On the 1st of January, the USA will have a debt ceiling at whatever the level of the debt is on that date. It means from the 1st of January 2025, it will be illegal for the US government to borrow any more until they raise the debt ceiling. They're going to start negotiations on that at some point, but certainly not before the elections on the 5th of November. And probably, if it's anything like the last time, those negotiations will continue for months and months and months. So what's happening in part is the Treasury is issuing short-term paper, i.e. borrowing as much as it possibly can before they're capped and not allowed to borrow anymore, and putting that money in the bank. So the cash balances at the Treasury have risen from a few, something like 100 billion back in May. It's about 700 or 800 billion now, and it's continuing to rise. And I have no doubt that by the time we get to 1st of January, their cash balance will be well over $1 trillion, so that they can ride out the negotiations. Because once they get to $1 trillion, if they can't borrow anymore, the only way you can pay the bills is to reduce your cash balance. So that's the game that the Fed's in at the moment, is not the Fed, the Treasury's in, is to get as much cash in the door by borrowing borrowing at the short end, so they have a very, very high loan balance. So when it gets capped on the 1st of January, they will have some cash to spare until they raise the debt ceiling.
That's interesting. Yeah. So borrow as much as you can and spend as much as you can before the 1st of January. It just seems very irresponsible. So we're going to move here into an interesting part. But before we do, just wanted to let the viewers know about the DirtyMan safe, Clive. I've spoken about this before. So what is a DirtyMan safe? Well, it's a way to secure your treasures or your gold coins or whatever valuables you have. I think it's really important in this day and age where law and order are breaking down in the West to have a little bit of safety. I'm not saying people should put everything in the Dirty Man safe, but yeah, it says here, begin your security journey with exclusive perks. Unearth the unmatched protection of Dirty Man Safe, a patent pending marvel designed for your peace of mind, durable, stealthy, smart. It's your underground guardian. So if you're interested, there's a link in the description below. You get a 10% off. And I think they're sending you a gift as well. And here's the Dirty Man Safe. So you open the top there, you put all your valuables in there, and then you can bury it wherever you want. So with that, Clive,
And don't forget where you buried it, Mario.
that's
There
right.
was a story in the newspaper a few weeks ago about a family who dug up their kitchen floor, and they found this huge hoard of coins, which are about 300 or 400 years old, that someone must have buried and forgotten about it.
Yeah, I saw that one here in England. Yeah, they had some really. I think they had an auction. I tried to bid for some of those silver coins, but I think there are lots. So I bid for about eight shillings from the 1600s, and I bid about 200 pounds. But I just checked a few days ago, and it went for 300, so I didn't get it. What I wanted to talk about now, Clive, and this is quite interesting, and it will show how, you know, things are still in terms of the gold price. I think we could go a lot further. And I want to talk about something called the gold cover. And a lot of people think that Nixon, destroyed the gold standard or gold backing, but it was actually LBJ who really got the ball rolling. So there's an article here from 2015 uh, from the National Interest. There's LBJ, and it says who really killed the gold standard. And there's a part here that says on March 8th, 1968, President Johnson signed a bill eliminating the gold cover. So that's the reserve backing for gold for Federal Reserve notes. So that's just M1, I guess, Federal Reserve notes. Prior to the removal of the gold cover, each Federal Reserve bank had been required to hold a gold certificate reserve of not less than 25% against Federal Reserve note liability. The gold certificates represented gold actually held by the United States Treasury. When the gold cover requirement was removed in March of 68, the ratio of the gold stock of the US to the Federal Reserve note liability stood at 25.0084. But notice that it used to be at 40% here because it says down here over the three, because I think uh, in 1965, I think Lyndon Johnson started lowering the ratio, and it used to be at 40, as you can see here. It says over the 3 years following that 1965 elimination of deposit reserve requirement, the U.S. gold reserve ratio dropped from well over 40% Federal Reserve note liability to over 25%. So first, I'll let you respond to that, Clive, and what you think. And then we're going to look at some calculations I did, looking at M1 today and the gold reserves.
Uh, well, it's interesting. I was trying to, while you were speaking, Mario, I was trying to do a bit of calculation on a piece of paper. I'm afraid my maths may not be as good as it should be, but I think the Treasury has got well, let's start again. The Federal Reserve has these gold notes, but they're only redeemable at the official price of gold as it existed at the time the gold window was suspended, i.e., at $35 an ounce. It's not,
I
they're
think
not
they raised it to, sorry, I
40,
think
43, maybe, yes.
42.22.
Yeah, okay. So they are although they're called gold notes, the gold actually belongs to the Treasury, as was mentioned in that article. So the Federal Reserve doesn't have the $500 billion of gold that some people suppose by calculating the amount of gold represented by those gold notes by the current gold price. They have the amount of gold represented by those notes multiplied by the $42 official price.
Yeah, which is,
That's how much they got.
I think it's about $11 billion in that.
It's something like that. Yeah, that would be if their total reserves are 40 billion. It's probably something like 10 or $11 billion.
Yeah.
Now, the Federal Reserve's balance sheet is something like 8 trillion. So I don't know what number we get as a multiple if we divide the 10 billion by the 8 trillion by 10 billion, but yeah, I can't do that in my head. There's too
Yeah,
many zeros, but it's
I've,
an awful lot.
yeah, I did some calculation here because notice that they say that the Federal Reserve notes have to be backed. So what I did here is I took M1, which is right now around 18 trillion, and 40% of 18 trillion is 7.2 trillion. And I divided it by the the US Treasury's gold reserves, and I know the Fed doesn't own it, but it's 261 million ounces. So there you go, 7.2 trillion divided by 261 million. So the gold price would have to be at 27,586.2 to have a 40% gold backing, like they had prior to 1965. And even if we go to 25% gold backing, so that's 4.5 trillion is 25% of the 18 trillion, we still get 17,241. And the other thing, Clive, that some people have done, for example, is look at, I think in 1980, the Fed's total assets divided by the amount of gold they had was over 100%. So the Fed's balance sheet was backed by more than 100% by gold because the price in 1980 in January went up to like almost $900. So I looked at the Fed's assets at the end of 1979. It was 158 billion, $0.2 billion. And as you said, right now, we're almost at 8 trillion. We're at 7.36 trillion. And the gold reserves haven't changed since 1980. They've been, constant. And I did the calculation. If we had 100% gold backing of the Fed's assets, we'd be around $41,200 for gold. So, some people might think, gold is overvalued right now at 2,300, but I think it's anything but.
And we mustn't forget a lot of other countries are trying to increase their gold reserves to provide a greater backing for their currency in case we have to get to a reset. So there's a long, long way for those countries to go in terms of buying gold to get to anything like enough gold to back it. So I think all the signs are fairly positive for gold at the moment. Mario, let me ask you a question, and your readers too, and I'll answer it in a minute. Do you know what the bugs index is? BUGS.
Bugs. Is it the gold miners?
Yeah, yes, but it stands for it's an index in the United States. It stands which trades, by the way, you can trade the futures. It stands for the basket of unhedged gold stocks. By unhedged, it means the gold miners who have not sold their gold forward for more than 18 months forward. And it contains stocks like Newmont, Barrick, Agnico, Inca, Franco-Nevada, and so on. And you can buy this index. The symbol is HUI. Unfortunately, it's not but BUGS, but it's known as the New York Stock Exchange ARCA Bugs Index. Just thought I'd share that with your users.
That's interesting. And yeah, and I think in the silver sector, for example, there's very few companies except with maybe, and I could be wrong, I think First Majestic, they try not to hedge their production forward. And Clive, could we, because I remember, when I worked in the markets and you probably would have been a client of mine. So we were in a different sector. You were a wealth manager. Even though I started out in wealth management, I was a futures and options broker for, people like you, for professionals and banks. I didn't deal with retail clients, but I remember every Friday, and it still seems to be when, first Friday of the month, you have non-farm payroll. For us, it was important because it created a lot of volatility and, we got busier, and the busier we got, the more commission we made. But as a fund wealth manager, private banker, I'm sure, the jobs data was kind of important, but not as important because you think more long term. So what do you think about today's numbers? Could it be important, not just in the short term, but how people, investors are gonna, digest that and think of what the Fed's gonna be doing next?
Um, did you say there's some numbers out today for the jobs data? I hadn't seen that.
Yeah. Well, it will be out at
Oh, it will be out. Yes. Okay.
one.
So the
Yeah.
last numbers were very, very bullish. A month ago, they showed that there's been a lot of jobs created. Now, you could believe that or not as you like, but I think broadly speaking, it's accepted to be a robust economy, at least for those who've got the jobs. And that's not helping the Federal Reserve in terms of giving them any ammunition to lower rates. So they can't, because they've got two mandates. The Federal Reserve's mandate is to keep inflation low and to have full employment. So we've got full employment, so they can't say we'll lower rates to try and get to full employment. And we have inflation, which now seems to be rising, so they can't lower rates to um, uh, sort of say we've achieved our target of low inflation. So I think what it really means at the moment, depending on today's number, which I suppose will be another strong number, that seems to be the trend at the moment. I think probably the Fed will have higher rates for longer, and it is entirely possible that at some point people start to predict a rise in rates. Certainly over the last 3 or 4 months, we've seen the projection of the number of cuts to be seen in 2024 and beyond. That number is reducing, and now it's starting. The proposed cuts by the Fed are. People are starting to predict there'll be maybe only 1 or 2 cuts this year, and maybe 1 or 2 next year. Whereas before it was all widely thought there'll be 3 cuts, and quite earlier this year, which we've already passed some of the landmarks when those should have happened. So I do think that we're not going to see lower rates at the moment unless we have some really bad data. And I also think that if the data is good, people will start talking about possible rate rises down the line, because really there isn't any sign of inflation going down, and there's no sign of the economy cooling yet.
Great. Thank you, Clive. I hope you have a great weekend, and I look forward to speaking with you next Friday.
Thank you very much, Mario. And I may not be available next Friday. We've got a bank holiday in Switzerland, so
All right. No, that's not
I'll let you know.
a problem.